Hello everyone and welcome to the last workshop of our single stock options program titled Expert Insight and Q&A. First, allow me to introduce myself. My name is Fawaz Al-Faris. I'm here representing Saudi Tadawul Group. I welcome our colleague Mark Taylor. Mark is a professional in derivatives and options, and he will be presenting our single stock options workshop today. This workshop is part of the single stock options program provided by Saudi Exchange, and it's also part of the Invest Wisely program, which consists of 4 stages: learn, engage, practice, and compete. I advise everyone to take a few minutes after the workshop and visit our page and social media accounts to get more insights and keep a lookout for future workshops. If you missed any of the workshops in this program, we've got you covered. Rewatch all the previous workshops either on our X profile or YouTube channel. Noting that we'll be providing attendance certificate to whoever attends the first 3 workshops and another certificate for the other 3 workshops. For any questions, please make sure to raise the hand or address your questions in the chat section at the end of the session. With that, I'll hand it over to Mark to start. Mark, the floor is yours.
Thank you very much and good evening, everybody. Welcome to session 6 of this 6-part course. So if you're still with us, congratulations, you've made it to the end. So this is the end of the second part, for which you get a separate certificate, different from the certificate you got for completing part 1. And the idea about this final session was that it was a little bit more free form. There was no formal materials that we were going to cover. We were just going to do some insight into trading options. If you remember from my background that I gave you at the start of session 1, I traded options professionally for an investment bank for 10 years. Since then, I've traded them on my own account as a retail trader for the last 15 years. So I have quite a lot of experience in trading the products that we've been talking about. So what I'm hoping to do today is to share with you some insights that I've got over the last 20 years or so trading options. And I've chosen a few particular things, particular facets of options, and maybe some pertinent experiences that I've been through in the past, which hopefully might bring to life a little bit some of the technical subjects that we've been discussing in the last couple of sessions as part of the deeper dive that we've done during part 2. I think as people, we tend to learn a little bit more from our mistakes than we do when things go right. So some of these experiences will be when things went wrong for me, and how it happened, how I reacted to it, and essentially trying to give you some signposts for what possibly not to do when you're thinking about trading single stock options on the Saudi exchange. Okay, so we've got the title slide in front of us. Let me just show you where we've been so far. So we're now right down at session 6. So part 1 just covered the basics of options, the mechanics, how we trade them to express a directional view on the stock, how we can combine them together to trade a slightly more subtle directional view on the stock, or maybe a view on the volatility of the market. And at the end of part 1, we had a gentle introduction to option pricing and risk. Part 2 started with a slightly deeper dive into this concept of volatility. Then last week, we had a session on option pricing from first principles, developing a framework to think about the price of an option, all the way up to this famous formula that we call the Black-Scholes formula. We're now going to hopefully have a look through all of those concepts as I talk you through certain elements of my own experience, and then other interesting things that I think you may want to know about. If you do have any questions, then we're happy to take those as we go. If you're in the Zoom room, then please ask those questions in the chat, and I'll pick them up and try to answer them as we go along. If you're just watching along on Twitter or YouTube, then you don't have the ability to ask questions, certainly not in real time, but hopefully we'll touch on a few things which will be interesting to you nonetheless. Okay, so what we're going to get from today's session. Hopefully some expert insight, if I can call myself an expert after 20 to 25 years experience of trading options, then hopefully I can give you some insight. Possibly some experiences to avoid, as I said before. Even better than learning from your own mistakes is learning from other people's mistakes. So you actually never lose the money, but you get the intelligence anyway. And then we'll have time at the end for any residual questions that you might have over that maybe have built up over the course of these 6 sessions. So I think my part here will probably take us through till about 7 o'clock, so about an hour, and that would leave us half an hour at the end for questions. I would anticipate probably we're not going to use all of that half hour for questions. So let's see how we're going in an hour's time or so, and if there's no more questions, then we'll finish things there. If there are questions, then we'll extend and see if we can answer those. Okay, so I've put together 5 different little topics that I thought we might touch on, and they all involve me to a greater or lesser extent. And actually, the final one is another trading combination that we didn't mention when we talked about trading options, but might be interesting to people if they want to have a look at that. So we're going to start off with this. What I call the long-short imbalance, and think about what net effect it must have on option prices in aggregate. So that it would take a big picture view of what this imbalance might do to general prices. So I'm going to speak quite generally here, and I'm also going to talk you through some of the experience that I've got when I've tried to analyze the prices of options to try to work out if they're trading at the fair level, if they're trading cheap, or if they're trading too expensive. We talked in session 4 about how you might calculate historical volatility, and if we're using that as a guide to what might happen in the future, then that historical volatility analysis can sometimes give you an idea as to whether options today look cheap or expensive relative to what happened in the past. And I'm going to lean on that to a certain extent here. I'm just going to move you across to my notepad because it's a free-form session. We'll be doing quite a bit of work on my notepad as I describe things. So I would say that generally speaking, in options, you've got 3 types of participants. You've got people who will either buy or sell. And they tend to be the more professional traders, hedge funds, traditional fund managers, retail traders who are trading the price of the option and not necessarily using the option as a vehicle to express a directional view on the stock. Those people will trade either long or short an option dependent upon its price. So if the price looks low, they want to buy them. If the price looks high, they want to sell them. So we have one segment of the market which will either buy or sell. And we have a second segment of the market which will only buy. And this is interesting. This comes down to the fact that options act a little bit like a lottery ticket to a certain extent. You pay a small amount today and you potentially have this huge win in the future. And so people are very comfortable. If I just draw out a long call position and then compare it to the kind of the 0 profit line, people are very comfortable taking a long or short, a long call or a long put position, knowing that the maximum loss is a relatively small contained amount, which is equal to the premium that they've paid. So this appeals very strongly to retail traders. It also appeals to a certain element of the professional trading community. I remember when I moved to the US, in one of the first weeks that I was there as a trader, I got taken along to a client meeting. It was in Boston, in Massachusetts. So we went up to Boston on the train, and we met this client who was a hedge fund. And they'd actually just set themselves up as a hedge fund in the last few weeks. So they'd got, I think, something like $2 billion under management. They were just hiring people and formulating their strategy. And they were very interested in trading options with us. We were the market maker, so we were open for business, either buying or selling options. And this was a hedge fund portfolio manager who'd been around for, I think, probably at least 15 years as a trading career. And he said to me, we trade a lot of options, but we only ever buy. So if we trade with you, we will be buying, or if we're selling, we will be selling an option that we previously bought. So they never took outright short positions in options. And again, it was this you can't lose more than your premium thinking that led them down this route. When I said to him, what happens when the price gets too high? They said, we just don't buy. So we express our trade through some other mechanism. If it's on the stock market, we'll just look to trade the cash stocks or maybe trade futures. But if options look attractively cheap or fairly valued, then we'll express the view through an option as well. So these two people, or these two sets, form what you might call end users of options to a certain extent. You've got traders, you've got investors, you've got hedgers, all in there. And the aggregate of all of this, so that the net position here is that these people are net long, because you've got some people who are either buy or sell, and then you've got other people who will only ever buy. And of course, the market has to balance out. For every buyer, there has to be a seller. And the missing link here, the balancing item here, is the people who accept this net short position. And this is the third party here. And these people are the market makers. So market makers, as we spoke about in previous sessions, a market maker will hold themselves out to be a buyer to every seller and a seller to every buyer. So it tends to be the case, certainly when I was a trader, that in the markets I traded in, the client interest, as far as the market maker saw it, was net long, and therefore the market making community as a whole was net short. Now, you may have individual market makers who are flat or long, but the whole sum of all of them has to be net short. Now, you might want to think about what happens to the equilibrium price of any product where there are more willing buyers than sellers. These market makers will be sellers, but they will do so at the price that they're happy to sell at. And that won't necessarily be some kind of calculation of the fair market value. That will be the price at which they think this demand will pay. So what tended to happen is that option prices, and this was true throughout my entire career as a professional trader at a bank, in the markets that I traded in, option prices were always greater than some kind of computation of their fair value. And the magnitude of this was something of the order of 10 to 20% higher. And the way that you would compute that is you would do this computation of historical volatility against implied volatility and just run through time and see what this discrepancy was. And over short periods of time, the discrepancy is going to be plus or minus something, but over a long period of time, it should average out at some stable level. And when I was asked to do this, actually, when I was a junior trader, one of the traders on our options desk got me to do this as a numerical exercise. I think he was just actually testing if I could do it. But the interesting outcome was I found that if I went back through 10 years worth of data, then it didn't really matter how I split it up. This persistent overpricing of options came through in the data. Now imagine you're somebody who looks at an option price and just decides, do I want to buy it or sell it based upon its level, based upon where I think it should be relative to fair value. And you see a situation where, generally speaking, there's a fair price for options, and you see the market trading up here. And what your temptation is every time you see this is you think, I want to sell. So in the markets I worked in, it was quite common for the traders in the market who were trading options, they weren't looking to use options to take a directional view on the stock. They were trading the option price itself. They would tend to come to the conclusion that I'd rather sell at that price than buy. And a lot of these traders, of course, were market makers, and therefore that's why the market makers ended up with this net short position, because they were happy to sell at that price. So it's worth having a think if you get into buying and selling options in whatever capacity that you're going to be doing it in. It's always worth bearing in mind if you've got a market that looks a bit like this, where there is this net long demand position coming from the end users of options, it's worth just bearing in mind what implication that would have for the price. There's one caveat to this story, and I do give this insight to quite a few of the people that I sit in front of in my guise as a trainer. The one caveat to this story is if you were to have a look at what's happening in the United States at the moment in the stock options market in the US, I think retail traders in the US have become a lot more comfortable selling options, and they don't always do it as a naked short sale. You know, that they don't always get an option price through a broker and say, okay, I want to go short that option. But they do it through products like the VIX that you may have heard of, VIX. That's a kind of futures contract, but it's a measure of implied volatility. So they might go short the VIX. They might buy some kind of ETF, which pays off if the market volatility is low instead of high. So as far as they're concerned, they've bought an ETF like you'd buy a stock, but its price movement will be driven by realized volatility in the market, and the price will go up if volatility goes down. So they find ways of taking effective short positions. So when I've looked at US stock options in recent years, I've found that this situation here doesn't exist anymore, and the options look more fairly priced than they did. But I don't quite know what the dynamic is that you'll find on the Saudi exchange. Maybe on the Saudi exchange, you might find a slightly more risk-averse retail community, possibly, and that might lead to this pronounced difference between the market level and where you think the price might be fair. So that was the first thing that I wanted to talk about. That it sort of leads us into the second thing. And the second thing is this, and this is particular to stock options. If you have a look at the volatility skew in stock options, it tends to always be one way round. So if we were to plot volatility versus strike, so let's say we'll take our classic 100 stock price today, let's call that the at the money strike. And then maybe we look at a 90 put and a 110 call. Then if you remember from last week, what Black-Scholes assumes is that all of them have the same volatility. There's no requirement to distinguish between the volatility of any particular strike. And what we learnt in the last few sessions was actually there are two effects. Firstly, there might be a smile, where the out of the money options just trade at a higher vol compared to the at the money. But what you tend to see in equities is something that looks like this, quite a pronounced skew. And it tends to always be this way around. Now, in interest rate markets and in foreign exchange markets, the two other markets that I have experience of trading options in, you don't see this pronounced skew. You see the skew much more a function of prevailing supply and demand factors. So it could be higher for calls or higher for puts, depending on what's going on in the market. In equities, it tends to be always this way around, to a greater or lesser extent. You know, you might see You might see it flatten off a little bit or steepen up a little bit, but there's always a persistent bid for puts, as we say. Now, this is being driven by a couple of things. One of them is a bit technical, and one of them is just a simple supply and demand argument. The technical bit is what we were talking about last week, the problems within the Black-Scholes formula and how we might correct for it. And one of the problems that we came across was this concept that the distribution of future prices might not be normally distributed. It might be fat-tailed with a thin body, but relatively symmetric. That's what causes the smile. Or it might be skewed one way or another with a fat tail on one side. So it tends to be, when you look at the price distribution, the realized price distribution in equities, it tends to look like this. So if that's the current market, then it has a mode, a most common value, which is skewed slightly to the right, but it has a fat tail on one side, on the low side. So for low strike puts, the market is saying that the probability of finishing down there is quite a bit greater than the normal distribution assumes. So the normal distribution would look something like that relative to probably even lower down in terms of that tail. So looking at this, if the market's trying to judge where the risk is, they think, well, the big unknown is a stock market crash. The market goes down 10, 20, maybe even more % in 1-2 days, or maybe over a week or so. And we all know what happens during stock market crashes. The kind of animal instincts of the market take over. People who otherwise would behave rationally are just running for the exits. And you get this herd effect, which leads to tremendous realized volatility in the event that the stock goes down. If stocks are going up, they tend to grind higher, 0.5%, 1% per day. Anyone who's had a look at the chart of the S&P 500 in the US over the last 2 months has just seen a daily grind higher for over about, I don't know, we've probably got the best part of a 10% move, I would think, over the last month and a half. But it's gone up in a kind of 0.5% a day increment. So when markets go up, when stock markets go up, they often go up in a very calm and measured way. And when they go down, they can go down chaotically. So the way that we react to this as traders is we say, if we just use Black-Scholes, this will underprice the put options, possibly quite significantly. And so we change the only parameter that's left for us to change, which is the volatility. And we say we're not willing to sell those puts unless it's for a significantly higher volatility than the at the monies. But because we're not worried about the high strike calls, we might trade those at more or less the same volatility as the at the money. And that's what gives us this skew. So it's an expectation around the probability distribution of a big move down or a big move up, and it always favors the big move down in terms of that being more probable than your default normal distribution assumes. So that's the technical argument. Because people fear stock market crashes, the way that you would protect yourself against a crash, if I want protection against a crash, let's say I'm a fund manager or something, the answer is to buy puts. Because if I buy puts, then if the market does crash down, I've got this asset that suddenly pays off, and that helps to protect against losses that I might have on my core portfolio. So obviously you buy puts, and that pushes the price up. If everybody's thinking this way, there's only really one seller in the market, and that's the market makers. And they set the price, so they'll just start marking the price up until they find natural sellers coming the other way. And until that happens, the price will just carry on going up. So demand from traditional fund managers who are buying what they call protective puts. So these are known as protective puts. And they don't always buy at the money puts. They might buy a kind of -5% strike or -10% strike or something like that. So you've got out of the money put buying, which helps to generate this this upward demand on the volatility. Now, if you think about what else fund managers do, there was another strategy that that they used to do, and that they used to. I think we covered this in session 2. They sometimes look for yield enhancement. So what they're wanting is, on top of whatever income they're generating from their long stock portfolio, they often run a strategy known as a covered call. So they'll sell call options, particularly when they think the market will be calm, as in quiet, and they look to take the premium and essentially add the premium onto their annual income. They hope that the call will not pay off, and therefore it's just a premium collection strategy. And the way that they trade these calls is they tend to choose high strike calls, so they might sell a +5% strike. So this is them selling, and then here they were buying. So if you think about, again, the demand and supply that they're going to put onto this chart, they're going to be pushing up the price of puts and simultaneously pushing down the price of calls. So that's going to lead to this skew coming through. So the raw expected distribution from a mathematical point of view says that puts should be worth more than calls if they're equally out of the money. And the supply and demand characteristics of the market, people protecting against a crash, people looking to try to collect premium in a calm market, all have the effect of leading to a net demand for puts over calls. Now, again, if you're a trader who comes into this, and this is how I tend to view equity options, your trader comes into this and you think, gosh, that's a pronounced skew. That's really quite steep. And at various points in my history trading stock options, I have looked at the skew in European stocks, American stocks, and I've always been surprised at how expensive the puts are. So if you are I guess a kind of technical value trader is how I probably would summarize myself. I don't trade options necessarily to take a directional view on stocks. I trade options dependent upon what I think of the price. I always look at stock options and think, I want to sell the puts and buy the calls. If you do want to do that, if you want to express the view that the skew is too steep, then the answer is to buy a risk reversal. And the risk reversal was that trade where we buy a call and simultaneously sell a put. Now, if all we get is normal times, then this strategy should work. What you should realize is that that fat tail never materialized. The high premium that you received for the put was more than adequate compensation for its risk. The low premium you paid for the call will just now net off against that high premium, and you should be a net receiver of premium over time. Your ideal scenario is you finish somewhere in the middle, neither option is exercised, and you just collect the net premium of the two. Of course, you can hedge the delta that this gives you by trading the underlying stocks, so you don't need to see this as a directional bet on the stocks. It's simply expressing a view on the relative values of those two trades. So if you now imagine that that might be the way that I look at stock options, I want to take you into part 2 here, which has a intriguingly titled Short Puts into COVID. So December 2019, I had this position on, and let's just draw it in terms of on expiry payoff. I was long calls, I was short puts. So what I would call a long risk reversal position. The puts were very expensive. In my opinion, the calls looked fairly priced, so the relative trade for me was attractive. I was also, aside from this, I was also outright short puts because I just thought I'm happy to express a directional view that the market either trades sideways or goes up. That meant buying calls doesn't necessarily pay off, but selling puts should, because I just collect the premium and the puts hopefully finish out of the money. And so you've got a stock market, and these trades were actually on the London stock market. So I was trading what we call the FTSE 100 index, which is the biggest 100 companies on the London exchange. And that was trading, let's say, around the, I don't know, 6,500-ish level. And then, of course, we come to COVID sweeping the world. So March 2020, this happened. And we had suddenly, in a matter of days, we had about a 30% move in the FTSE 100. Now, you can see this is going to have a quite horrendous effect on a position like this. The overall, essentially, I've got a combination here where you might say that this is giving me some long delta, as in long stocks. So a bet that stocks go up. This might be delta neutral, as in I've hedged the delta, but I'm, to give it a slightly approximate name, I'm short the fat tail. What I've done is I've tried to monetize what I thought was the overpricing of these puts. I thought the market was being unnecessarily pessimistic. Of course, this was actually just bad luck. There was no way that in December the market knew what was coming in March. So I just mistimed this. In other periods of time, this would have been a good trade. In this period, it was a disaster. And I actually took probably a cumulative 2 years worth of profit, which I've been patiently generating through my option trading strategy, and I lost it in a week. And that's the effect that you can have if you try to go against the risk aversion of the market. The risk aversion of the market will tend to buy protection against fat tail events, these black swan events that happen every so often, but not very frequently. If you go against that, then you just have to be prepared that if one of these fat tails comes up, it can be quite destructive to your P&L. So short puts into COVID, that was certainly a chastening lesson for me, a lesson that left me slightly humbled as a trader of stock options. So there you go. Just essentially the lesson here is if you're net selling options, just be careful of those tail risks. Just be careful of always understanding, even if I've not seen a move like this for 5 years, that doesn't mean that its probability is 0 of happening in the next 3 months. Okay. Some of these examples, by the way, they're not all in stock options. So I've traded interest rate options and FX options as well. So, but they're all relevant to the product, which is options. And so all of these will have carryovers to the world of stock options. So we're gonna think about what happens here. I've called this example pinned on a strike. I just want to remind you, I'm going to do this via a spreadsheet. What happens to the price of an option when we get quite close to the expiry date? So I've got a graph here of the price of an option. Let's just expand it slightly. And let's change the expiry to be 1 year. So with 1 year to go, and actually, while I think about it, let's put in the on expiry payoff profile. So let me just add another column here. Just bear with me. Okay, so there's your on expiry payoff. is the orange line, and the blue line is the price today. So as the market moves, if I've got a year to expiry, I slide up and down that relatively smooth blue line. The gradient is not too steep and scary. It's not changing very fast as the stock moves up and down. So with a year to expiry, the risks in an option are fairly benign, fairly muted. Then if we change the time to expiry, let's make it half a year. What you'll notice is that blue line starts to descend onto the orange line. So we just see it tucking in, and you start to see that in the wings over here, where the exercise probability is either going down towards 0 or up towards 100%, the option starts to essentially die away. It either becomes a future position in the stock on the right-hand side, or it becomes completely dead on the left-hand side. And again, if you just keep your eye on those tails, if I reduce this expiry again to quarter of a year, you can see that again, we're ever further squashing ourselves down towards that on expiry payoff. And now the period where the option is essentially mathematically dead is getting wider and wider. And the bit that is giving us any kind of trading interest really is tighter and tighter around the strike. Now, in session 3, when we talked about risk, we understood that one of the principal risks on an option is what we call delta. And the delta is the gradient of this price curve. It tells us how does the price move for a unit movement in the underlying stock. So what you've got is up here, the delta is 1. The price of the option is just moving 1 for 1 with the stock because it is just a position in the stock. And down here, the delta is 0. And then in this range here, the delta is somewhere between 1 and 0. And what you'll notice is as you reduce this expiry, let's have a look at a 1 week expiry, so 1/52nd of a year. With a 1 week expiry, you can see that really, unless you are right around the strike, the option has finished, that there is no what we would call optionality left. It is mathematically dead. It's either in the money and destined to just be the stock, or it's out of the money and destined to just be 0. And it's only that small area around the strike, which is interesting. And then if I take this down to a tiny amount left, you see that it just tends down to that on expiry payoff. So with 1 day to go, options are essentially dead everywhere apart from right around the strike. The problem with this, of course, is your delta now, if this was a mathematician looking at this, they would say that my delta is now discontinuous. It is no longer a smooth function between 0 and 1. It's now a binary function. It's either 0 or it's 1. So we've got a delta that looks something like this, 1 or 0, and then we have this vertical change in between around the strike. Okay, if I'm just using options to trade a directional view on the stock, this doesn't really matter so much to me. I'm viewing this from a trading point of view as just being, my outcomes are just dependent upon where the stock finishes. However, if I am hedging my risk as an options trader so that when I have a delta position on the stock, I can take an equal and opposite position using the cash stocks themselves. The cash stock delta remains constant, but the options delta will change, and the more quickly it changes, the more I have to rebalance my position. Now imagine you're a trader here, and we start the day, and the stock is trading down here at, let's say, 97. And your delta is 0, your option is dead. You have no hedge against it, so you're not traded any stocks against it. And then we get a big move up in the stock. So let's say the stock goes up to 102. Now your delta is 1. And let's say you're long, let's say you're short, just to make things interesting. You're short 1,000 contracts. And if you remember, 1,000 contracts is equivalent to 100,000 shares. Well, now your option is saying you've sold a call, somebody will be exercising this imminently and buying 100,000 shares from you. So as your hedge, you should go out and buy 100,000 shares. So when the market goes up, suddenly you need to do trade one, which is buy 100,000 shares at a price of 102. Now let's say the market went back down again to 99. When the market's at 99, my delta is 0 again. So my option is now saying, oh, you're fine. I'm going to finish worthless. Nobody's going to exercise me. But you're long 100,000 shares at a price of 102, which now have no purpose. They're not hedging anything anymore. So of course, now you have to do a rebalancing trade and you have to sell 100,000 shares at 98. And now imagine the market bounces up again, back up to 102. And suddenly the option's saying, hooray, I'm alive again. You are soon going to be selling 100,000 shares at the strike. So you better go and buy all those shares. So again, you have to go out to the market and buy 100,000 shares at 102. And I think you can probably see the pattern that's developing here. I am repeatedly buying high, selling low, buying high, selling low, buying high, selling low. And the more that we oscillate around that strike, the more money this is going to cost me if I am short the option. Now, this change of delta we call gamma in the world of options. And I just want to show you another brief Excel sheet with a nice looking graph on it. So let's just switch across to that. This is showing you how the gamma behaves on an option. So this axis here is the time to expiry. So you can see we're going from, and this is in days, by the way, 266-ish days, all the way down to almost 0 days at the end of that axis. This axis here, this is strike. So I want to draw your attention to the low days to expiry and being right around the strike. You can see this is telling me how rapidly my delta is changing. And actually, as time to expiry tends down towards 0, your gamma tends to infinity. Now, anytime anyone in finance says to you, I have infinite risk, that's a reason to be scared. And this happens to option traders if they are hedging their delta and they take an option right into expiry and it's trading right at the strike. I have watched, and this was again in my experience as a junior trader, I have watched a trader lose their entire year's P&L, and this was in June. So I was sitting on the FX options desk. I watched someone lose their entire year's P&L in an hour. So they'd been trading for 6 months as a market maker, and they lost everything in an hour because they were pinned on a strike. I think it was in euro dollar, euros versus dollars. And the market kept going up and down and up and down, up and down through this strike. And because you don't know when it goes up, you don't know if it's going to go down or up next, you have to hedge and you have to lock in these losses every time you do it. I mean, poor guy was almost in tears by the end of when it finally came to the exercise, but that's what can happen. So again, the learning point here is just be a bit careful of the risks that options can start to develop if you're right around the strike and the expiry is very short. When I was a trader at a bank, I actually knew that there were smaller banks than us who, to control this risk, they actually had a risk management rule that said if there's a week or less to go to expiry, and you are a certain distance away from the strike, and it was usually measured in standard deviations. So let's say you are within plus or minus 1 standard deviation of the strike with a week to go, and that's the weekly standard deviation, then you have to close the position out. It is now too likely that you end up getting pinned on that strike. you have to close the position out. And fortunately, at the time, I worked for a big bank, and we were very happy to take these positions off small banks because they would essentially pay us money to take this risk on because it was something they were not willing to run themselves. So risks tending to infinity around the strike on expiry. This is a property that on the options can give you. Stocks, futures, any linear instrument can't give you this infinite risk problem, which makes obviously options both interesting, exciting, and terrifying in possibly equal measure. Okay, I just want to move on to something else. I want to talk about a particular example that I witnessed in a market, and the effect that it had on many people who were selling options at the time. So I'm just going to clean this up a little bit. I'm going to move back to my notepad to describe this. Okay, so there was a situation, and this is a foreign exchange story, but it has carryovers to the world of equities potentially. There was a situation where we had the currency pair euro versus Swiss franc, and some of you may be aware of this. It started to go down in the financial crisis. So this was around, I guess, 2008 to 10-ish. The rate was going down. The Swiss franc was strengthening against the euro. And the Swiss National Bank, the central bank of Switzerland, came in and they said it can't go below a certain line. And the line they picked was 120. And so what they said is, if it dips down below 120, so let's say the rate's up here, if it tries to dip down below 120, then the Swiss National Bank comes in and buys, and that forces it back up again. So what happened then, it just bobbled along at 120, and this was known as the peg. Now, strictly speaking, this is not a peg. A peg is when you have a symmetric target. All they wanted was it went no lower than 120. Now, imagine if you're an options trader here, and you think that the Swiss National Bank will be here forever, defending this level, and you are told that there is let's say, a 119.50 put with a price which is greater than 0. You might look at that and think, this is free money. This is free money because how can this ever pay off? If every time the market goes down to 120, it bounces back up again, how do we ever get a situation where a 119.50 put ever pays off? And so people were quite confidently selling these strikes. So they would pick a kind of cascading set of strikes down here where they would sell, and they're selling puts, and they're essentially selling puts that they think are worthless. So what the traders here are thinking is that I'm taking free money from the market. This is just a premium collection technique, and these puts will never pay off. And for a year or two, this all worked out fine. And of course, when things are working fine, people become more confident in strategy, and people become ever more comfortable going short puts here. So you can probably, even if you don't know the story around the Swiss franc peg, you can probably judge what's coming next. There was a press conference called by the Swiss National Bank. They didn't tell the market what it was about. They just said, we're going to have a press conference at, let's say, 2 o'clock this afternoon. And at the press conference, the head of the Swiss National Bank turned up and said, we're going to stop defending the peg. That was it. Just out of the blue, no warning, no preemption at all. We're going to stop defending the peg. And the Swiss franc plummeted. sorry, the euro plummeted, the Swiss franc strengthened, and it went down to about 0.85 before then dramatically bouncing back up to about 110. And all of this happened on no trading volumes. It was just repriced. The market just reassessed the correct level. So people are short puts, and the market's just crashed straight through all of the strikes. They can't even close them out because there's no market. Everyone's just paralyzed. They're just watching the chaos unfold. So no one's trading options. No market maker is providing prices for people to exit at. And so there were people who went bankrupt, personally bankrupt. There were lots of retail traders that went personally bankrupt. There were lots of retail brokers that went bankrupt because when they sent margin calls out to these retail traders, they couldn't even get anywhere close to being able to pay. And if the broker doesn't have enough margin, they're bankrupt as well. So this took down at least 2 foreign exchange brokers in London, and hundreds, if not thousands, of retail clients went bankrupt because of this. Again, this is short tail risk. This is looking at the market and thinking something with a very low probability is not going to happen, and therefore I'm happy to bet against it. And it's just, for these people, again, just like with me and COVID, it was bad timing. Had they stopped doing this 3 months before the Swiss National Bank made their announcement, they would have been fine. But this is what fat tails do to you sometimes. Okay, so that's the Euro Swiss story. I've just got a message on the chat. It's just to me, so I'm just going to catch up on that. So just give me 30 seconds or so. Okay, thanks for that. Let's just go back and see what else I had on the schedule. Okay, so calendar spreads. This was something that actually I left out of session 2 because I thought it was maybe slightly more advanced than we were at in session 2. But it's probably worth us having a bit of a discussion about that now. Okay, right. Let me go back to the notepad. Okay, so a calendar spread is when we do this. We've looked previously at what we might call vertical spreads. And a vertical spread is if you've got, if I'm, let's just plot expiry versus strike. You might do, for example, a call spread. And a call spread might have a 110 strike and a 100 strike. So you pick the same expiry, and you might buy the low strike, sell the high strike, and we have that sort of limited payoff that we recognize from session 2 when we talked about call spreads. This is all single expiry trading. So you've just picked the 1 week expiry, 3 month expiry, whatever it is, and you're just taking a directional view on the stock for that particular expiry date. What we mean by calendar spreads is actually when we trade what the market might also call a horizontal spread. So again, if I look at strike versus expiry, what I might look to do is trade the same 100 strike, but at 2 different expiry dates. So I might have got the 1 month, let's say, and the 3 month expiry. And again, typically I'll buy one and sell the other. So let's say I go short and long. So I'm short the short expiry and I'm long the longer expiry. So just thinking about this, I wonder if you can just take 30 seconds maybe and just have a think, what might the motivation be for a trader who trades calendar spreads? What are they looking for the market to do? Or what kind of price behavior do you think they might be anticipating? So I'll just give you 30 seconds to have a little think about that, and then we'll go through a couple of ideas that are behind the motivation for this kind of trade. Okay, let me just think, go through this. So I'm just going to copy this over onto the left-hand side. Oops. So there's a couple of possible motivations for this. Let's think about what they might be. So motivation one. Motivation one might be what I would call a path dependent view. And a path dependent view says I have a particular idea of how the stock price will evolve over the next 3 months. And for example, let's say it starts at 100 today. If I think it goes down and then up, then I'm quite happy to do the calendar spread this way around, because what I'm really thinking is that 100, let's say these are both calls. So I should make that just like in the call spread example. I'm quite happy to sell that 100 call because actually I think that the near-term weakness in the stock price is going to mean that 100 call has a low probability of paying off. But then if we get the rebound I'm expecting and stocks go back up, then the long-dated call that I'm long should then provide me with a positive payoff. And so what you've got is you've got a premium reduction because you are receiving premium here and then you're paying premium here. The longer dated option, as we saw last week, will have the higher price, but at least when you're selling one and buying another, the premium is that you pay the net of the two and not just the outright long position premium. And so if you did have this directional view on the stock, then that would be this kind of calendar spread would be something that you could think about. Now, it's not obvious what might cause you to think that this directional view is going to come true. Maybe let's think about, I don't know, American stocks or European stocks. If you had an idea how inflation was going to evolve in the US or Europe, you then might have an idea about how stocks might move. If you think inflation news is going to be bad for the next month or two and then suddenly be good, then you might expect that stocks may go lower over the short term, but then higher over the longer term. Okay, so that's one possible motivation. Let's have a think about motivation two. Motivation two is what I might call the short vol trade. Now, if you think that the market's going to be generally calm, then what you might like to do is sell that 1 month option and buy the 3 month option. And the reason for that is the way that option prices change as we go from if I have the premium here against expiry. If I imagine how much an option's worth at 1 month, sorry, at 3 months, and then 1 month, and then 1 day, the way that the premium changes is it's not a straight line like that. The premium actually comes down on a concave curve. So if you ever graph this, you'll see something that looks like this. So you get an accelerating decay of premium. And I think the intuitive way to understand this is if you've got a 3-month option with 90 days left to expiry, if 1 day goes past, you've only lost 1/90th of its time to expiry. But if I've got a 2-day option and 1 day goes past, I've lost half the remaining time to expiry. So I've lost a much bigger proportion of its residual value. So if you imagine that you've bought the 3-month option, so you're long up here, and you've sold the 1-month option, then if the underlying stock doesn't change, and all that happens is time passes, then both of your options are going to roll down this curve. But as you can see, the short position rolls down a steeper bit of the curve than the long position. So let's say after 2 weeks has passed, here's your long position here, the new location, and then your new location for the short position is down here. And so what you experience is a gain here because something you've sold has gone down in price. And then what you experience here is a loss because something you bought has gone down in price, but the gain is bigger than the loss. So what we would say if we were trading these is if I buy a calendar spread, which means that I am long the 3-month, short the 1 month, if we choose those expiries, then I would describe this as a short realized vol position because it's dependent upon the stock staying relatively constant. And I would describe it as a positive carry trade, which means that I will just earn money as time goes past. And this is because it has a net positive theta. Remember, theta was the Greek letter that we assigned to the way that an option price changes as time goes past. Now, if the stock moves, then this gets ruined to a certain extent. Each option will move off down its risk path, and we can't always say that this will remain a positive carry trade regardless of where the stock is. But certainly if the stock stays around the strikes, then as time passes, it should neatly decay down to us. So another idea that you might look to express a view that says the market's going to be relatively calm is by doing this kind of long calendar spread position. One final thing I just want to mention, it's related to the chat message that was sent just directly to me. The chat message was just relating to people who trade only the price of an option. They're not concerned about taking this option into expiry. Remember, when you're trading on an exchange, there will always be a buying and selling price that you can exit any position at. So you might buy a 3-month option today and you might sell it tomorrow. So what happens in 3 months' time is largely irrelevant for your holding period. And so this is a perfectly valid technique to trade options. What you're really doing there is you're being a pure option trader. You're saying, I think the price looks high, or I think the price looks low. I think the stock might move up or down and therefore drive a movement in my option price. And so if you're trading the price, then what you've got to bear in mind is that your P&L is going to be driven by the risk metrics that we talked about in session 3. So it's going to be driven by your delta, which is a function of where the underlying stock is. It's going to be driven by your vega, which is the level of implied volatility. And it's going to be driven by your theta, which is the passage of time or your time decay. And so if you have a view on implied volatility in the market, you think implied volatility is going to go up, then you can buy options and the price should go up if you're right. And if you remember from session 2, the product that people tend to trade if they think volatility is going up is a straddle. So they buy a call and a put with the same strike. The delta on these trades is close to 0. They will just increase in price if volatility is marked up by the market, and they'll decrease if it goes lower. Good. If you actually have the reverse view and you think volatility will be lower, then you want to go short the straddle, and then you'll make money as the inevitability of finishing in that sort of positive payoff triangle there asserts itself over time. So yeah, that's yet another way that you can trade options. Okay, I've covered most of what I intended to go through. It's taken about an hour and 10 minutes, so we do still have some time left for any questions you might have. Please, if you're in the Zoom room, you can drop those into the Zoom chat, and I'll try and answer them now. We also do have the email address, which we've publicized at the end of all of these sessions. So if you do have any residual questions after sitting through 6 of these sessions, maybe the question doesn't come into your head until tomorrow morning, please feel free to fire it off to this email address, and we'll look to get back to any queries that might come through. So we've got now, well, 15, 20 minutes if anyone wants to ask any questions. But if you don't, I've reached the natural conclusion of what I intended to say. So if you have sat with us for all 6 sessions, thank you for coming along. Thank you for listening patiently. I hope that some of what we've said in the last, God, what is it, 9 hours? 9 hours of chatting from me. I hope some of that has answered some of the questions that you arrived with on day 1. Maybe if you arrived knowing nothing about options, you now know a bit more than you did. Yeah, it's nice of you to have me along. It's been a pleasure doing these courses, and I wish you all the best in your experiences trading these options on the Saudi exchange. So thank you very much. Yeah, you're free to go if you have no questions. Thanks for attending. But if you do have questions, as I say, we'll hang around for a few more minutes to see if we can answer those. Someone has just put something on the chat saying, how can I receive the educational material? I think that's being sent out to you if you registered for the course. You can, of course, find the recordings on YouTube. So you can go back and look at all 6 sessions if you want to. So there's that kind of recap as well. So thank you very much. I'll sit here patiently now and see if any questions come in. But if they don't, you're free to go off and enjoy your evenings. And thank you very much for attending our sessions.